My name is Michelle Creed, and I'm excited to be with each of you today. I'm also delighted to be joined by three of my friends and partners, Eddie Keith, Nate Walton, and Dave Schwartz. This morning, we'll walk you through an overview of our platform and our market, and we'll also share with you some of the exciting growth opportunities that we're seeing today. First, I'll start by saying who we are. Our team consists of 80+ professionals dedicated to the secondaries space. Our team has been investing in secondaries now for more than 30 years. And in the last 3 years since acquisition, we've grown our assets under management by more than 30%. Our private equity team, seen as a pioneer in the space, should also be noted as an innovator of creative liquidity solutions. In our real estate and our credit secondaries teams, they're the standalone leaders within their markets. This is measured both in terms of assets under management as well as dedicated investment professionals. In our infrastructure secondaries team, this team is one of the top players in the space and continues to be seen as the player for structured solutions today. Now that I've talked about the who, let me talk about the how. How do we execute on secondaries on a daily basis? It really comes down to access. It's access to sourcing, it's access to data, and it's access to capital. As we think about the sourcing side, our ability to have conversations with groups in the market on the brokerage side that we've been speaking to for years is really important. It's what provides us with the ability to get that first and that last look in a portfolio transaction. And now our ability to have conversations with the more than 2,000 Ares LPs and our internal colleagues of more than 1,000 investment professionals, that's what enables us to have not only differentiated deal flow, but directly negotiated transactions. And it's access to data. We can leverage the more than 3,000 portfolio companies that's Ares invested in, as well as the nearly 290 million square feet of property globally. That data enables us to not only efficiently underwrite portfolios, but also to intelligently construct a bottom-up analysis. And as we think about access to capital, with 4 discrete pools of capital and the ability to stretch across the platform, we can really be that one-stop shop and that one-stop solution provider in the secondary market today. So I've talked about the who, I've talked about the how. Let me talk about the what. What have we been able to achieve over the last 30 years? You've heard today that performance is really key to future success. And so take a look at the numbers on the screen. These are our since inception returns, and we couldn't be more proud of them. Our ability to buy seasoned assets and to buy these assets at discounts to their intrinsic value, that's what enables our team to be able to produce this level of returns for our investors historically. And as we look ahead, recognizing that we've generated gross IRRs north of 20% across each of our established businesses, I can't be more excited to see what the future holds. So with that, I'll turn it to Eddie, who will talk about the markets.
Thank you, Michelle. So I've been investing in secondaries for about 18 years. Our industry has been notoriously bad about underestimating its own growth. And I think the reason for that is you usually get the definition of secondaries wrong. For a long time, people thought secondaries was a specific deal type. Secondaries is actually, it's a suite of solutions. Secondaries is the market-based solve for the constraints and challenges associated with investing in private markets. If you keep that definition in mind, you'll know where secondaries is going, and you'll know where the growth is coming from. So let's start with the first constraint, the 10-year fund life. There are plenty of reasons an LP needs to get out of a fund before that 10-year period. And secondary solution for that was the LP trade, very well understood at this point. Private equity, I'd argue that that market is mature, but just because it's mature does not mean it's not going to grow. If you look at the amount of capital that's locked in the NAV and unfunded in private markets, it's about $3.8 trillion. Secondaries, about 2% of that volume is going to turn over annually. So as that 3.8 trillion grows to 4.5 to 5 trillion, secondaries is going to grow with that, even in the most mature market. But what gets really exciting is when you look at the right side of this page. Real estate, infrastructure, credit. Not only would that secondary market grow as more capital goes into those markets, but these markets are not mature, nowhere close to mature. You haven't hit that 2% turnover rate like you've got in private equity. So not only are they going to grow as the asset base grows, they're going to have a turnover rate that moves closer to that 2%, so you can have a doubling just from that, coupled with the growth in the asset class. It's not a coincidence that Ares has invested heavily in these high growth markets. As Michelle mentioned, we're the market leader, the largest in terms of AUM and team, in credit, in real estate, and one of the larger players in infrastructure. But I want to go back to that definition because the story doesn't really end there. As I mentioned, secondaries is a solution for the constraints in the market. So what about the inverse to that constraint I talked about a minute ago? An LP that needs to get out of a fund before the end of that 10-year period. The inverse of that is LPs and GPs who want to hold assets longer than that 10-year fund life would afford. There's nothing natural, inevitable about a 7-year, 8-year hold period. The finance gods do not come from on high and say that you can't get more juice out of an asset after you've held it for 7 years. It just doesn't work that way. The mere existence of a big sponsor-to-sponsor market tells you a lot of these assets have additional upside beyond the 10-year fund life. So the second solution, the second challenge for secondaries to solve was allowing GPs and LPs to hold their best assets, the ones they want to hold longer than the 10-year fund life would afford. That solution was the GP-led deal. Unlike LP deals, this market is nowhere close to being mature. You'll know it's mature when LPs can hold core holdings in private markets just like they have their core holdings in public markets. You might hold your Amazons, your Apples for 20 years. Eventually, LPs will be able to do that in private markets, and no one will tell you they can do that today. It's sporadic. These opportunities come every once and again, but that market's nowhere close to mature. So I think this GP-led opportunity is probably in the second or third inning with a lot of runway left. And you're seeing that growth already. If you look at the last 3 years, GP-led opportunity has grown more than 2 times compared to the prior 3 years. And again, to Michelle's point, this is a market we have a big competitive advantage in, given the breadth and the scale of our platform and the perspective we have on these private companies, given the direct lending platform. Now, in a way, I'm still only scratching the surface. There are a lot of other constraints in private equity. Think about risk clustering. You ever notice that most private equity funds have the same return target profile, 20% in 2? There are a lot of investors who want to reduce that risk. That's where pref comes into play in context of secondaries. You take that raw material that's in private markets, you take risk out of it, and you lower the beta. So when you think about the different ways it's going to grow, more assets in private markets, maturation of some of the newer asset classes, the growth in GP-leds, and then what I'd call innovations that we don't even know what they're going to be yet, where secondaries is solving problems for investors. We think there's a path to exponential growth in the overall secondary market. And again, our goal at Ares is to make sure we're positioned for the areas that are going to have that highest growth as we build what we believe to be the secondary firm of the future. So with that, I'm going to hand it over to my colleague, Nate Walton. He'll talk a bit more about what we're doing.
Thanks, Eddie. As Eddie mentioned, we're always looking for where the secondary markets are growing or trying to match our product offerings to that growth. And so 3 years ago when we bought Landmark, they had 3 core businesses in private equity secondaries, real estate secondaries, and infrastructure secondaries, all solid businesses that will continue to grow at what we believe to be above average market rates. But we also looked at where could we expand our product offerings and our asset classes. And in the last 3 years, we've launched 3 new vehicles. 2 of those are in the private equity segment, which I'll talk about here shortly, and 1 is in the emerging asset class of credit secondaries, which my partner, Dave Schwartz, will talk about here shortly. So you have the core businesses and you have the expanding new offerings. And so we'll do a little bit of a deep dive today on some of these new offerings. In private equity, as Eddie mentioned, this is what we would refer to as the most mature secondaries market. It's been around 30 years. In fact, Landmark was largely credited with being one of the first, so an innovator in that space. However, this market has continued to grow and evolve and solve solutions and presents new opportunities. One of the reasons we think this makes a lot of sense is for the wealth channel to get their exposure to private markets. And so as Raj was speaking earlier, he was talking about why private equity secondaries over time we believe will be the preferred way for the wealth channel to access private equity. It makes intuitive sense. How many individual investors can have 10, 20, 30 GPs that they invest in? Many institutional investors struggle with that kind of deployment and that kind of monitoring. And so you can invest through a secondaries fund and get the vast majority of that exposure through one investment. And so we knew that secondaries would be the right asset class to get exposure to private equity, but what we have evolved and innovated on is really the way in which they can do that. And that comes with the launch of our Ares Private Markets Fund just over 2 years ago. As Raj mentioned, it's only just begun to scratch the surface to date. We recently went over $1 billion in AUM on this vehicle. And the reason we think this vehicle makes so much sense is because it allows an individual investor to get fully invested on a monthly basis. You don't have to wait years to have your capital draw down. You don't have to manage capital calls. You simply can invest in this vehicle, and if you want liquidity at some point down the road, you can ask for liquidity. We think that is how the individual investor will ramp their exposure into private markets and private equity in particular over the coming years. So we're really excited about this Ares Private Markets Fund. We think it's got a lot of momentum in front of it. On our more traditional secondaries offerings, we recently launched a new product around Ares Global Structured Solutions. And that's a term you may not have heard before in secondaries, but I think it shows the innovation of the asset class. What does that mean? It means that you have thousands of general partners in the world who have billions of dollars of assets on their balance sheet, largely in the form of GP commitments. And you have thousands of limited partners in the world who have billions of dollars of LP commitments. So you have all of these assets that are out there. And historically, your two choices are to hold your asset or to sell your asset. Well, there's a third option, which is to raise capital against your assets. And that's what structured solutions effectively do. We provide capital, either liquidity or growth capital, to both GPs and LPs. And in exchange, we get a preferred rate of return. Sounds a lot like what we do in a lot of our credit parts of our business. That predictable rate of return, providing capital against existing assets, is a secondary skill set that we have. We've been a market leader in this space in our own private equity business over the last 10 years. We've done $6 billion of these transactions. It's represented over 30% of our last few secondary funds. And because the market opportunity continues to grow, recently reaching somewhere in the $8 to $10 billion range, we decided to have a separate dedicated pool of capital just to go after this opportunity. It currently represents about 10% of the secondary market today, and we think over the next 5 years that market share will grow. So we're excited about the innovations, even in a market like private equity secondaries, which has been around for 30 years. And so with that, I'm going to turn it over to a newer asset class and let Dave talk about credit secondaries.
Great. Thanks, Nate, and good morning, everyone. Credit secondaries, as Nate mentioned, is our newest vertical within our broader secondaries franchise. And we're extraordinarily excited with the opportunity to leverage our 30-year history in secondaries and our 20-plus-year history in direct lending. Our enthusiasm and conviction about the opportunity is predicated upon the observation that you now have the key ingredient for any secondaries market to emerge, and that's namely a large and vibrant primary market. You certainly have that today with a 1.7 trillion private credit asset class, which is expected to continue to grow to 2.8 trillion by 2028. Obviously, a meaningful amount of AUM in this asset class, but more relevant for credit secondaries are the sheer number of investors that have approached this market. For us, what that means in credit secondaries is that represents prospective sellers. Now, most of these investors in private credit are going to be fundamentally content with the performance of their manager, particularly if they invest with Ares in direct lending. But a portion of them will be required to divest of their fund stakes, largely due to the same reasons they sell private equity real estate and infra, including the need for liquidity first and foremost, a desire for portfolio rebalancing, as well as a new CIO and changes in their investment mandate. The good news for those sellers is you now have a credible buyer universe to absorb the supply that's now come to market. You have folks with the appropriate cost of capital, the right amount of capital, and at least in the case with Ares, real domain expertise. And so you've now seen the credit secondaries market, which was largely anecdotal for the last couple of years, $1 billion to $2 billion max, has quickly grown to a $20 billion of annual volume being brought to market, with all expectations that this market will continue to follow the primary market and grow to approximately $50 billion here in relatively short order. That gets us extraordinarily excited here at Ares about that opportunity. And as Jared mentioned earlier, we are meaningfully investing behind this opportunity. And since launching the business a year ago, believe we've already established a leading market position. As you can see here, that investment that we've made shows up. We believe we've already put together the industry's largest team focused on this burgeoning growth opportunity of 12 people. Importantly, credentialed backgrounds of both lifelong secondaries practitioners, as well as folks who spent their entire careers in Ares in direct lending. So we have a real appreciation for who we're investing in, but also what's in their underlying portfolios. Our team has already activated our multi-channel sourcing networks, and we have seen over $26 billion of opportunities in credit secondaries to date over the last year. And importantly, we believe we've already put together meaningfully differentiated and scaled capital to this market to the tune of $2 billion. And we're happy to announce a recent close of $1 billion for our dedicated credit secondaries vehicle. We're extraordinarily excited about the burgeoning growth opportunity in credit secondaries and the market position we've established today. Wrapping it up for our secondaries panel, as you heard from Michelle, we are extraordinarily pleased with the business we have built here at Ares in secondaries. We believe we are scaled and market-leading businesses across private equity, real estate, infra, and now credit with over $25 billion of AUM. As you heard from Eddie, there are meaningful tailwinds supporting our secondaries platform, including continued growth in all of our primary markets, as well as increased need for liquidity by private markets investors. And as you heard from Nate and me, we continue to innovate and develop new products for our investor base to meet market demand as well across our fastest growing segments that include structured solutions, real estate, infrastructure, and now credit secondaries. So with that, we're now going to turn it over to our good friend Matt Swartnia to cover private equity. Thank you.